In this chapter, we're going to discuss mortgages, land contracts, the financial crisis, and then just some security measures. So first, mortgages are when real property are used as security for a loan. And a security is an assurance that a creditor will be paid back for any money they have loaned. Lenders of money and people who extend credit usually require security devices to protect their interest. And a secured loan is one where the creditors have something of value from which they can be paid if the debtor doesn't pay. So if I borrow money and I don't pay and it is a secured loan, the lender can take whatever is the collateral, whatever the loan is secured by. A security interest is the right to use collateral to recover debt, and then an unsecured loan is one where the creditors have nothing of value they can repossess and sell to recover the money owed to them by the debtor. So a credit card is an unsecured loan. When I buy things on my credit card, if I don't pay, the credit card company can get a judgment, but there's no specific asset they can go and take. That's why credit cards have such high interest rates. When I use real property, and real property is land, buildings, things like that. When real property is used as security for a loan, it's called a mortgage. And a mortgage is a transfer of an interest in property for the purpose of creating security for a debt. There are two parties to a mortgage. The mortgagor is the one who borrows the money, and the mortgagee is the lender. And the lender, the mortgagee, has a lien in the property that is used to secure the loan. Mortgages are pretty expensive. They come with a lot of fees. These are the common fees: application fee, appraisal fee, credit report fee, inspection, origination fee, points, document prep fees, attorney's fees, title insurance, survey fees, termite inspections, mortgage and homeowners insurance. There are quite a few fees that are implicit in borrowing money and securing it with real property. And there are a bunch of different kinds of mortgages. We're going to talk about some, not all. And I'm not going to read this to you. You can read it yourself, and it's also in your book. But these are some common types of mortgages that are used to purchase a home. The most common is the traditional conventional fixed rate mortgage. This one is not backed by the government, so it's just approved by a bank, and it's backed by their own underwriters and according to their terms. It involves no government backing by either insurance or guarantee. It's made by private lenders, and the risk of loss is borne exclusively by them. There's also variable or adjustable rate flexible mortgages. So in a conventional mortgage, usually the interest rate would stay the same over the life of the loan. So it might be a 15-year mortgage, a 20-year, a 30-year, and traditionally the interest rate would stay the same. If I have a flexible rate mortgage, the interest rate is going to change, and it's going to be tied to some index, which is tied to the market. And it will have an agreement probably that includes a maximum rate of interest that can't be exceeded. But the rate will generally rise as the market rate rises. There's an interest-only mortgage, which allows the borrower to only pay the interest on the loan. So they're not repaying any of the principal, any of the amount they actually owe. They're just paying interest, and that's for a set period of time set by the agreement. There's a graduated payment mortgage. This has a fixed interest rate during the life of the mortgage. The monthly payments made by the mortgagor, though, are going to increase over the term of the loan. So it starts smaller, it gets larger. There is a balloon payment mortgage, and it has pretty small upfront payments during the life of the mortgage, but then at the end of the mortgage, there's one big final payment called your balloon payment. The mortgage has a fixed interest rate, but it's written for a short period of time, such as 5 years. There's also a reverse mortgage. These are used usually by older homeowners, and they are used to sometimes fund their retirement. So it allows older homeowners to convert some of the equity in their home into cash while they retain ownership of their home. So it's, like it says, it's a mortgage in reverse. A lot of times older homeowners might own their home outright with no debt, and so they will execute a reverse mortgage in which a company will pay them money over a period of time. Usually they're allowed to stay in their home till they pass away. And then once they pass away, their home goes to that mortgage company. There is a participation loan where the borrower transfers certain ownership or equity rights to the lender, and in exchange, the borrower will negotiate lower interest rates or a lower down payment. There's also a construction loan. It's going to authorize staggered payments at various stages of the building process. So usually there would be a payment, say, when the foundation is poured, when the land is purchased, when the framing is finished, when the exterior is finished, and when the whole home is finished. So there'll be periodic payments in a construction loan. There is a deed of trust, which in some states we use deeds of trust instead of mortgages. So in a conventional mortgage, the mortgagor conveys all or part of his or her interest in the property to the mortgagee, but in a deed of trust, the mortgagor conveys his or her interest in that property to a disinterested third party who is a trustee. The mortgagor remains on the property, but the trustee holds certain rights to that property as security for the mortgagor's creditors. So they're very similar, just kind of different mechanically. There is such thing as a subprime loan, and a subprime loan is going to be offered to borrowers who've been disqualified from a conventional loan because of a bad credit history or a low debt-to-income ratio. They usually have a higher default rate, probably higher interest, higher fees. There's a junior mortgage, which is usually a second or subsequent mortgage. So I get my primary mortgage on my home, and then if I want to borrow more money, I could apply for a junior mortgage or a second mortgage. And that mortgage will be subject to the first mortgage. So if I don't pay that second mortgage, if they want to come take my house, they first have to pay off my first mortgage to get to take my house. A home equity loan is a loan or line of credit made available to homeowners based on the value of the property over and above any existing mortgages. A home equity loan takes advantage of equity in property, and I get to borrow off that. So if I have a home and it's valued at $400,000 and my first primary mortgage is $200,000. All right, so I have $200,000 of equity in that home. I could get a home equity loan, say for $100,000, to borrow on that equity. A home equity loan is different than a mortgage because the money I borrow in the home equity loan doesn't necessarily have to be used to improve my property. A lot of times it is, but I could borrow it and do something else, pay college tuition or something like that. A land contract is an agreement to purchase real property where the seller promises to finance the buyer's purchase of a tract of land, and the buyer agrees to repay the seller in installment payments. All right, this is similar to a conventional mortgage, except there's no bank involved. It's the seller now who's financing the purchase. So the buyer makes payments directly to the seller. Once I get a mortgage, it must be in writing and it must be delivered to the recorder's office in the county where the property is located. Usually it's in the courthouse. I record a mortgage because I want to notify any third party who might be interested in purchasing the property or in lending money to the owner that the mortgagee has an interest in the real property covered by the mortgage. So recording a mortgage basically sets people on notice. If you've ever bought a house, you know that it takes a while from the time that you put a contract on the house to the time you can close. There are many reasons for that, but one of those reasons is the title company is looking through all of the recording records. They're looking in the county records to see who might have an interest in the property. Because as a seller of property, I'm not allowed to sell something to a third party and not pay my mortgage, or not pay my second mortgage, or not pay off my line of credit. Anything that I have borrowed subject to a security interest in my home, I must pay off before I can sell my home. And so the reason that we record it is to notify everyone at the time of sale that I, as a bank, have an interest in that asset. and I need to be paid before the property is sold and before the owner gets any money. I get the first payment. So the mortgagor has a right to possess the property. Remember, the mortgagor is the owner of the property. They have the right to possess the property, the right to any income produced by the property, so they could rent it, the right to use the property for a second or third mortgage, and the right to pay off the mortgage in full. They have the equity of redemption. They also have some duties. They must make payments on time, preserve and maintain the mortgaged property. Usually when I agree to a mortgage, I agree to have insurance on that property. I agree to maintain the property. I agree to pay taxes and assessments. I must pay all taxes and assessments. The mortgagee is the one lending the money. The mortgagee has the unrestricted right to sell, assign, or transfer the mortgage to a third party. So if I borrow money from Chase Bank to buy my house, Chase Bank can sell that loan to another bank, and they can collect on that loan. They have the right to receive each installment payment as it falls due, the right to apply to a court to have the property sold if the mortgagor has defaulted. They cannot lose their interest in the property without due process. And mortgages often contain a clause providing that if the property is sold, the mortgage becomes due and payable. If the mortgage does not contain such a clause, the property may be sold with the mortgage remaining on it, but the old purchaser would still be liable on the mortgage, or they could assign it to the new purchaser if the mortgagee agrees. All right, so if you think back or if you read about 2008, the economy really took a nosedive in 2008, and a lot of the reason was because of mortgages. It was mismanagement of Fannie Mae and Freddie Mac, which were government mortgage programs. So that's one cause. The development of securitization is another, and the increased use of faulty loans is another. And we're going to talk through that here. So first, Fannie Mae is the Federal National Mortgage Association. They don't make mortgage loans directly. They buy mortgage loans. So they purchase loans that were made based on strict guidelines set up by the Federal Housing Association and the Veterans Administration, so FHA and VA loans. FHA and VA loans are generally government-backed loans, and then Fannie Mae would purchase those loans that were made. Congress also created Ginnie Mae, the Government National Mortgage Association, which took over a lot of Fannie Mae's debt when Fannie Mae was getting too much debt, freeing Fannie to buy more mortgages insured by the government. Congress also created Freddie Mac, Federal Home Loan Mortgage Corporation, which was another government-sponsored entity to help support the mortgage market. All right, so we had these entities making loans, FHA and VA, and we had Fannie Mae and Freddie Mac buying those loans. Okay, and we had restrictions on what they could buy. But slowly, the government lifted some of those restrictions, which permitted them to buy loans that had not fallen within the FHA or VA guidelines and authorized them to participate in securitization. And securitization is when a bank or other lender lends money to a borrower who pays off the loan over time with interest. The lender makes money on the interest at a slow and steady rate over a period of years. And that's how mortgagors traditionally made money, through securitization over time. Okay, but now these big banks decided that they would bundle mortgages together and sell them as bonds, so mortgage-backed securities. Okay, so now rather than making money over time through mortgages, they grouped a bunch of these mortgages together and sold them. So these banks were lending money and then making money up front by selling these mortgages to someone else. All right, and someone else included private investors, private banks, but it also included Fannie Mae, Freddie Mac, and Ginnie Mae, right? Because remember, they were allowed to buy these mortgages. So now they're in the game too. They're buying these mortgage-backed securities. Okay, well, what do you think happened? If I am a bank and I make money on my mortgage slowly over time by collecting on those payments. I care whether or not my borrower can actually qualify for that loan or make the payments. That's easy to see. But what if I'm going to make my money right after I make the mortgage up front by selling the mortgage? I care much less whether or not my borrower can make the payments. All I care about is getting them initially qualified for the loan and then selling off that loan. Okay, so what happened is that there was a growing popularity of these asset-backed securities, and the original lenders started to care less about whether the borrowers were financially qualified to pay back the loans because the lenders were passing the risk on to those who purchased the securities. People who bought them, government-sponsored entities like Fannie, Ginnie, and Freddie, but also private entities, commercial banks, investment banks, and dozens of private lending firms, such as Merit Financial, all started purchasing these asset-backed securities. And then, as you would expect, people started to default. People couldn't make their payments. So the use of loans experienced a huge resurgence in the middle of the first decade of the 21st century. Because technology aided faster loan processing, approval was based on a mathematical probability of repayment rather than the traditional criteria of credit, capacity, capital, and collateral. And then we had a push toward deregulation. People were also making liar loans and ninja loans. Liar loans are loans that deliberately misstated the qualifications of a borrower to push a loan through the approval process, again, so the bank could just sell that loan off to someone else. And then ninja loans were also made, and those were loans that were made to a borrower with no income, no job, and no assets. All right, so this was a recipe for disaster, right? All of these loans went into default, or not all, but a lot of the loans went into default. So, and when they all went into default, it sent, of course, the housing industry into crisis, which sent Fannie, Freddie, and Ginnie into crisis, which sent the stock market into crisis, and it really had a dramatic effect on our economy. So to try to fix it, there was a takeover of Fannie and Freddie by the Federal Housing Finance Agency. They created, which we're going to talk about later, HAMP, HARP, and HAMP, two programs to help borrowers who had loans basically they had no business having. They established TARP, Troubled Asset Relief Program, and we passed the Dodd-Frank Act. Okay, so first, two GSEs were hit by enormous losses as the housing crisis hit and mortgages began to default. This is Fannie and Freddie. Their portfolios were filled to capacity with these mortgages that should never have been made. They were purchased by subprime borrowers, adjustable rate mortgages, ninja loans. So the government stepped in to save them both by forming the Federal Housing Finance Agency. All right, so again, this happened in 2008. This agency was a merger between the Federal Housing Finance Board and the Office of Federal Housing Enterprise Oversight. It had the power to regulate these government agencies, and it also was charged with reestablishing public faith in the mortgage market by restoring the stability, continuity, authority, and dependability of the entire lending system. So we modified Fannie and Freddie again to minimize the role that the federal government had in Fannie and Freddie. And the main battle there was between conservative lawmakers and liberal counterparts. Conservative lawmakers, of course, wanted the government to have no involvement in Fannie and Freddie. And then, of course, the liberal counterparts wanted more government involvement in Fannie and Freddie. We also created the HAMP program, Home Affordable Modification Program, and this was designed to help homeowners who could no longer pay their mortgages but wish to continue making payments on their mortgages. So they couldn't make all of their payments, but they wanted to stay in their homes and they wanted to continue making some payments. They wanted to support these homeowners. It provided help to the private banks and other lenders who owned those mortgages and tried to encourage them and help them restructure those mortgages to help those homeowners. The government also created HARP, the Home Affordable Refinance Program. This is a complementary program to HAMP, the modification program. It operates under the authority of the Federal Housing Finance Agency, And this one is designed to help homeowners who were not in default on their mortgage payments. So they were still making their payments, but they were what we call underwater. They owed more to the bank than the home was actually worth. So say their mortgage was $100,000 and their home was only worth $80,000. And so this encouraged banks to work with those homeowners. There's also the Troubled Asset Reform Program, the TARP program. This program was designed to allow the government to buy many of these troubled assets that had resulted from this epidemic. And finally, Dodd-Frank. Dodd-Frank was a huge reform act passed by Congress. It consisted of 16 separate titles, many referred to as separate acts. Title 14 is also called the Mortgage Reform and Anti-Predatory Lending Act. This deals with this new act prevents the problems, or is supposed to prevent the problems that happened in 2008. It requires a lot of new things of lenders. If you've closed on a home since 2008 and you'd closed on one before 2008, you know that you have a lot more paperwork and a lot more hoops to jump through. It requires lenders to make a good faith attempt to ensure that all borrowers have the financial ability to repay the loan taken out to finance the mortgage, determine whether the borrower can pay all taxes, insurance, and all other assessments, include an exam of specifically defined documents that provide concrete, verifiable evidence of the borrower's income stream, credit history, debt-to-income situation, employment, and other financial resources. It requires lenders to use documentation supplied by the IRS or some other comparable third party to verify all this information. And certain types of mortgage arrangements are either outlawed or limited by the Act, including mortgages with balloon payments that more than double the previous payments. The Dodd-Frank Act also created qualified mortgages, which have met the good faith requirement outlined in the Act, and it outlawed certain types of lender-related compensation. So lenders used to be compensated to make certain type of loans because they could then sell those loans. That is now outlawed. All right, so we talked about mortgages and defined mortgages and the parties and the types of mortgages and the types of securitization. And then we talked about how mortgages led to the financial crisis. And now we're going to move on to personal property as security. So mortgages, remember, were real property as security, and real property was land, buildings, homes. Personal property is property that I can see, touch, and feel, but that is not real property. So tables, chairs, office furniture, desks, lamps, whatever. Article 9 of the UCC covers personal property, and it brings all personal property security devices or security interest under one law. Property that's subject to the security interest is called collateral. And a secured party is a lender or seller who holds the security interest. And to have a security interest, it attaches. So a security interest is said to attach when the secured party has a legally enforceable right to take that property and sell it to satisfy the debt. It is said to be perfected when the secured party has done everything that the law requires to give the secured party greater rights to the goods than others have. So if I am a lender, I want to have not only an attached security interest, but I want to have a perfected security interest. So I have a higher, better, more valuable right than any other person in that asset. These types of personal property are often used as security. First, consumer goods, and these are things that are bought for primarily use by personal, family, or household products. There's equipment, which are goods other than inventory. Farm products are consumer goods. Farm products, which are crops or livestock or supplies used or produced in farming operations. Inventory, which is goods other than farm products that are held for sale or lease, or raw materials used or consumed in a business. There are fixtures, which are goods that are so related to real estate that an interest arises in them under a real estate law. There is a purchase money security interest, all right, and that is a security interest taken by a lender or a seller of an item to secure its price. So I lend money for something and I take a security interest in that something. Okay, so It's not, I don't lend money based on an asset you already own. I lend you money so you can go buy an asset, and then I have a security interest in that said asset. And a buyer in the ordinary course of business is a person who, in good faith and without knowledge of the sale, is in violation, without knowledge that the sale is in violation of ownership rights or security interest of a third party, buys goods in the ordinary course from a person in the business of selling goods of that kind, not including a pawnbroker. Okay, so a buyer in the ordinary course of business can take greater title to an asset than someone with another security interest, with a perfected security interest. A security agreement is an agreement that creates a security interest. It must be in writing, be signed by the debtor, and contain a description of the collateral that is used for security. So I buy something, I borrow money, I sign a security interest, and it meets all of these definitions. It's in writing, signed by the debtor, and contains a description. In order for that security interest to be valid, it has to attach. A security interest attaches when 3 conditions are met. First, the debtor has some ownership or possessive rights in the collateral. Second, the secured party transfers something of value to the debtor. And third, the secured party takes possession of the collateral or signs a security instrument that describes the collateral. Okay, so normally in number 3, the secured party signs an agreement that describes the collateral. Creditors can obtain security interest in property acquired by the debtor after the original agreement is entered. So the creditor would do that by placing a provision in the security agreement that the security interest of the creditor also applies to goods the debtor acquires at a later time. That's known as a floating lien. And that lien is important to creditors who take security interest in goods such as food items that are sold and replaced within short periods of time, or small inventory items, things like that. The lien is lost when the goods are sold, but regained again as soon as the debtor takes possession of the new property. Okay, so I borrow money, sign a security agreement, it attaches. If I am a lender, I also want to perfect that security agreement. So I can perfect in one of 3 ways. I can perfect by filing it. So I file a financing statement in a public office. Usually that is in some county office. It may be a central office or a local office where the debtor resides or has a place of business. And the proper place for filing is going to depend on the type of collateral, and it's going to vary from state to state. In certain circumstances, there's perfection by attachment alone, and that's when I have a purchase money security interest in consumer goods. So again, remember, consumer goods are things I use in my household usually, and a purchase money security interest is one where I borrow money and the lender takes a security interest in the thing I borrowed money to buy, okay? And if that is a consumer good, the interest is perfected by attachment alone. So the moment it attaches, it is also perfected. It can also be perfected by possession, and that's when the secured party or the creditor takes possession of the collateral. This is called a pledge. A secured party who has possession of the collateral must take reasonable care of the property, and the debtor must reimburse the secured party for any money spent to take care of the property. Okay, so this is all important because of priorities and claims, because sometimes 2 or more parties may claim a security interest in the same asset, the same collateral, and we need to know who wins. At other times, an unsecured party may claim they have a better right than a secured party. And the UCC Article 9 is going to help resolve these conflicts. And they are resolved generally as so. A perfected purchase money security interest in inventory has priority over a conflicting security interest in the same inventory. A purchase money security interest in collateral other than inventory has priority over a conflicting security interest in the same collateral if it is perfected when the debtor receives the collateral or within 10 days thereafter. Buyers of goods in the ordinary course of business prevail over security interest in the seller's inventory. Buyers of farm products in the ordinary course of business, to the extent that they pay for and receive collateral without knowledge of the security interest, take precedence over non-perfected security interests. Buyers of consumer goods are not affected by perfected security interest of which they have no knowledge. In all other cases, a perfected security interest prevails over an unperfected one. Conflicting security interests rank according to priority in time of filing or perfection. And when two or more parties have unperfected security interests in the same collateral, the first to attach prevails over the other parties. So this is why attachment and perfection is important, because those first rules I read to you were very specific, but those last three are general, and most things fall under those general rules. So I'm going to go over those again. So first, a perfected security interest is always going to prevail over an unperfected security interest. So if I am owed money and I never took the time to perfect it, and I lent that money in 2005, and a new lender lends money in 2020 and they perfect it, they win over me. They can repossess that collateral before I can repossess that collateral. Conflicting security interests rank according to priority in time of filing or perfection. So it's a race to the courthouse. Whoever is the first to perfect by filing wins. And then finally, if two or more parties have unperfected security interest in the same collateral, the first to attach prevails over the other parties. But if two or more parties have unperfected security interest, one could go file and perfect and then always win. So that's why that is important. If a debtor defaults by failing to make payments when due, the secured party may satisfy the debt by taking possession of the collateral. When it does that, the secured party is required to sell that collateral at a public auction or a private sale to recoup their investment. Anything that they receive over the amount of their loan, they must return to the debtor. That is rare, but sometimes it could happen.